Get Rich Education is brought to you by Norada Real Estate Corporate Direct and Ridge Lending Group. Cash flow real estate investors, this is Get Rich Education's Keith Weinhold. Did you know that you can finance up to 35 income properties all with one lender? Ridge Lending Group specializes in investment property loans, and they do it in almost every U.S. state. Ridge has worked with tens of thousands of real estate investors and homeowners all over the country. They've been doing this for investors for so long that at this point, they've helped more families realize their dreams of becoming real estate investors than any other mortgage lender in the country. To find out more, visit ridgelendinggroup.com.
Welcome to Get Rich Education with Keith Weinhold, giving you information and ideas on the investment that has turned more ordinary people into millionaires and billionaires than anything else, and can provide you with more wealth and happiness than you ever thought possible. Now, here's your host, investor, entrepreneur, business owner, and educator, Keith Weinhold.
Hey, welcome to GRE. This is Get Rich Education, episode 99. I'm your host, Keith Weinhold. Thanks for being here, but you're not here for me. You're here for you. Today, we're talking about financing of your income property, and we're doing it with the principal of the mortgage company that has helped more people realize their dreams of financial freedom than any other mortgage lender in the country. Sounds like someone that belongs on GRE, doesn't it? That's Ridge Lending Group President and CEO, Caeli Ridge. Now, I've hosted Caeli on the show once before, and for that show, we discussed the questions that I had and that I thought you would have. Well, we're covering a lot of new material today because this time I asked Caeli if she would discuss what the most frequently asked questions are that she gets from borrowers over time, those FAQs. We discuss purchases, cash out refinances, and we're going to talk about something called a delayed cash out refinance. And that product is maybe something less for the buy and hold people and more for hands-on renovators or flippers. How do you recalculate your debt to income ratio when you're actively adding income properties to your portfolio? We're going to cover that. And we're talking about conventional financing of income property, not primary residences, and not FHA, VA, USDA, or hard money loans or other types of loans. But those conventional loans, they're the ones with the lowest interest rates and the best terms on income property. We are just one episode away from milestone episode 100 next week. We'll do something a little special there. We'll play some snippets from some select GRE episodes. So, for example, you'll probably hear Harry Dent's voice or Robert Kiyosaki's voice from when I hosted them here on certain episodes. We've also got Get Rich Education's own business developer and my best friend, John Collins, coming on to episode 100 to appear alongside me for a while next week. So you know that it's got to be a special occasion. John will be on the air with me for a lot longer than when he was here the first time. You know, John's kind of more of a behind the stage guy than me, and I'm more comfortable being front stage, which is actually kind of weird because if both he and I attend the same event in person, well, then it seems like John's the one working the room where I'm less outgoing than he is. So I'm not exactly sure how that works, but that's all next week for episode 100. After that, in episode 101, we'll be talking about geopolitics, geography, and how that intersects with real estate investing with Peter Zeihan, someone who has worked with private intelligence companies. So he's extremely well connected to national and global trends and really ahead of the trends. And that's just information that you will not hear publicly. So I'm so privileged to have him booked to appear. That will be episode 101. After that, we have the return of terrific Rich Dad advisor Tom Wheelwright. And then after that, it will be the absolutely incomparable mindset and motivation mogul and global sensation T. Harv Eker making his Get Rich Education debut. Let's talk about investor mortgage loans. Ridge Lending Group really is an extraordinary company. They specialize in residential investment property financing. Their president and CEO is with us today, and she's also a fellow real estate investor, so she knows what investors need. She spent the last 15 years as a nationwide lender, loan officer, and real estate investor herself. And she's held dozens of investment properties herself at any one time across the United States. She and Ridge Lending have worked with tens of thousands of real estate investors and homeowners all over the country, and they have a distinction of helping more families realize their dreams of income property investment than any other mortgage lender in the country. She maintains and serves her real estate investor database of 60,000 strong and growing. So when it comes to mortgage loan scenarios or questions that you might have, she has pretty much seen it all. Here she is. Welcome back on to Get Rich Education, Ridge Lending President and CEO, Caeli Ridge.
Wow, thank you so much, Keith. What a lovely introduction. I appreciate it. I'm very excited to be here this morning with you and hopefully being a part of your listeners' education piece that's important to us. So thank you for having me.
Yeah, it's great to have you back. Now, you are an investor-oriented mortgage company, and most are owner-occupied oriented ones. So, I guess what are some of those examples that you find when someone calls in and deals with Ridge Lending, and how you can particularly help investors more so than owner-occupied homeowners?
Yeah, that's a great question, and I think an important one. I think that people often don't understand the profound differences between owner-occupied type conventional lending versus non-owner occupied type conventional lending. It's a very different playing field. And to use maybe a sort of overplayed analogy, I would say that it would be similar to going to a brain surgeon for heart surgery. It really does have that kind of an impact. If you're working with someone that doesn't understand the ins and outs and the underwriting guidelines specific to investor type loans, it can be an even more arduous process than it is already. So for those reasons and the fact that we've been doing this for so long, second generation company, I've been in this industry for about 18 years. And being an investor myself, I think really holds some extra value for our clients and the education that we provide. Those are a few reasons I think that we are over and above more well suited than just the average lender out there.
Now, before you came on today, we discussed the fact that it might be a good idea to talk about some of those common FAQs, those frequently asked questions that investors often have for your company that you're answering over and over again. So I thought that we could help our listeners and prospective borrowers and just answer some of those questions right here. And again, we want to talk about, now we're focusing on investment property loans. So with this discussion, we're largely talking about conventional financing of properties that you don't intend to occupy. And, one potential snag or one common question is the seasoning of funds and gift funds prior to purchase, and using some care about that. Tell us about that.
Another good question. So for the purpose of qualifying for these conventional investment loans, the seasoning of funds related to your down payment and, of course, the reserve requirement is pretty specific. We're looking for 2 months worth of seasoning, meaning from a documentation standpoint, we need to show 2 months worth of bank statements that show the funds that we're using for either the down payment or reserves originated with the individual. So for example, if there were a large deposit listed within either of the bank statements that we've collected, we need to be able to trace that, paper trail it back to the individual as having originated with him or her. An example of what wouldn't work, let's say that Great Aunt Alice left somebody $50,000 and said, "Here, Jimmy, here's some money, go invest in real estate." Now that would be fine as long as those funds had sat in their account for a full 60 days of bank statement cycle. So if, let's say, the deposit was made August 23rd, those funds would not be admissible as sourced and seasoned until we had the September and October bank statements to show the balance versus that large deposit, which of course we could not paper trail as having originated with the individual.
Okay, so that's really important. So gift funds and funds from others might be just okay, but you better show 2 full months bank statement between that gift deposit and between when you're trying to originate a loan and you're having an underwriter look at those documents.
Exactly.
All right. And boy, I really wish I had a Great Aunt Alice. Never had one of those that gave me $50K to invest in property. Anything else about gift funds and as it relates to earnest money deposits as well?
For earnest money deposits, well, let's just talk about seasoned funds, and as related to earnest money deposits, the gift funds I think has been explained. But just as a sidebar, the down payment funds must be in liquid form, right? Liquid form funds are going to be simply your checking, your savings, your money market accounts. Certain stocks are considered liquid. Down payment and earnest money cannot come from the non-liquid accounts. These are your retirement accounts, your 401ks, your self-directed IRAs, whole life insurance policies, etc. The reserve requirement, however, can be in the form of either liquid or non-liquid, but it's important to understand that distinction. So the down payment must be liquid, and the reserve requirement can be either liquid or non-liquid. And one other detail I would share is for the non-liquid accounts, only 60% of the face value of that account is admissible for underwriting purposes. So most commonly, let's say we have a $100,000 401k, 60,000 of that $100,000 asset would be used for qualifying in a conventional underwritten mortgage.
Okay, that's a great tool that one can use. If they don't have liquidity, at least they can use 60% of retirement funds toward qualification toward the reserve requirements. And let's talk about the reserve requirements. So, let's say I'm an investor and I live in and own my own single family home. Oh, and let's say I also have 3 investment properties currently in my portfolio, 3 single family investment turnkey properties, and the one I own or occupy. How much would I need to hold in reserves?
Excellent question. First, let me baseline and say that the reserve requirement changes depending on how many finance properties an individual currently holds. In your scenario, it's 4 finance properties, a primary residence, and 3 rentals. So the answer about reserves is applicable to, there's 2 answers. The first is applicable in loan spots 1 through 6. There's a second set of guidelines that apply to investors that have 7 through 10 finance properties. Let's start with 1 through 6.
Okay.
The reserve requirement is equal to 6 months worth of PITI, right? Principal, interest, taxes, and insurance, and HOA, of course, if it applies, on the subject property, plus an additional 2 months of PITI in each of the subsequent loan spots 1 through 6. So in the example that you gave me, and keep in mind the owner-occupied PITI is not admissible. It does not count in this formula, just the rentals. So in the scenario that you provided, you've got 3 investment properties you currently hold. You're looking to purchase your 4th. That 4th property would require 6 months PITI in reserves, plus an additional 2 months for each of the subsequent 3 in those spots. Make sense?
Yeah, that makes sense. And then back to the primary residence, is there a reserve requirement PITI on the primary residence in that scenario or not?
No, the primary does not count in that formula, only the rentals.
Okay, so that would be 2 months showing reserves that could cover the principal, interest, taxes, insurance, and association dues payments, 2 months worth each on the 3 investment properties. And then what we're calling the subject property, the one that we're trying to get a loan for, we'd need to show that we have 6 months worth of PITI on that one that we're contemplating purchasing.
Exactly right. Now, those are the rules applicable to loan spots 1 through 6. What happens is that in the 7 through 10 loan spots, they raise the bar on us a little bit in qualification. It now becomes 6 months PITI on all rental properties retroactively.
Okay, so if you've got 7, 8, 9, or 10 rental properties, now we kind of fall back to where we need 6 months PITI on numbers 1 through 6 and 7, 8, 9, or 10.
Yes, exactly. Not to include the primary residence.
Right, okay. And we can, of course, as we talked about, include 60% of non-liquid retirement funds in that.
Exactly right.
Okay. Now, when it comes to LLCs, I know a lot of people have questions about limited liability companies and ownership percentages of owning those properties. Should the borrower be the 100% owner, or is it okay if they own things 50-50 with the spouse? Or how does that work when one tries to originate loans and what they do have in LLCs and what they don't? Are there some considerations around that?
Absolutely. So assuming that one is going to look at LLCs for asset protection, from a conventional loan perspective, if you were to execute most commonly a quit claim deed after closing and transfer title ownership from your individual name into your LLC for that asset protection, in doing so, you need to make sure that it is either a single member LLC where you are 100% owner. The only other feasible alternative would be 50-50 with a spouse. That is allowed. If you were to have a multiple member LLC where there were 2, 3, 4 other individuals, that is not allowed. It changes the ownership of the property, of course, and that becomes a problem. So single member 100% LLC or 50-50 with a spouse are the only legitimate LLCs allowed for that asset protection piece.
Okay, and just as a reminder, Caeli and I are not dispensing legal advice. Go ahead and consult your own legal professional. But yeah, that's pretty much the deal right there when you boil it down. So, speaking of a spouse, there's really merits currently of reaching 20 spots with a conventional loan if you go ahead and separate out your property ownership with your spouse. So, tell us about that, about the husband and the wife, and they want to qualify for the maximum amount of rental properties. What are some thoughts there?
Yeah, I love this question, and it comes up almost daily. I wish that more people were aware, so I'm glad to have this platform to educate your listeners. A lot of people don't understand that when going into a loan as a joint application, a borrower and a co-borrower, husband and wife situation, what they've done in doing that is they've eaten up one of those conventional loan spots. We refer to them as the golden tickets, right? This is the highest leverage at the lowest interest rates you'll find on the planet. So what they've done then is they've kind of worked their way out of exhausting an additional loan spot for them. So what we advise, assuming that by separating the two individuals, the qualifications are there independent of the other, we can open up, instead of 10 per the combined, there's now 20 conventional loan spots, which really opens the doors for that long-term passive income wealth building scenario. So really important to double check qualifications. And if you can qualify individually, you want to make sure that you do not go on the loan with your spouse, whereby eliminating one of those otherwise available loan spots to you.
Got it. So as we're thinking long term, the husband might want to begin, for example, putting income properties in his name only for the first 10, and then just say when they reach number 11, begin to put them in the wife's name for spots 11 through 20.
Sure, that's a very feasible scenario. Depending on what their current circumstances are, how aggressive they want to be with their acquisition, they may want to start jointly together where he does one or two and then she does one. One of the reasons for that would obviously point to interest rates and where they might be in the future. So kind of maximizing that availability now versus a year or 2 years from now. But I think it's subjective to the current goal of the couple.
Well, let's talk a bit about cash out refinances. A lot of times I talk about the merits of cash out refinances, and cash out refinances, that does so many things for us. That potentially increases our cash flow because we have equity in the property. The return from equity is always zero. We can go ahead and remove equity from that property. And as long as the interest rate, the note rate that we pay on those additional funds borrowed are exceeded by what we invest those funds in, that's a real credit to us. And we've just created arbitrage for ourselves. So you mentioned something about a difference between a delayed cash out refinance and a standard cash out refinance. Tell us about the differences.
Yes, this can get just a little bit complicated. So let me take a minute and give a baseline understanding of a refinance as related to an investment type property. So there are technically three different types of refinance for a non-owner occupied. There's just a rate and term refinance where one might refinance their existing loan and replace it with a new loan at longer or better terms, just a simple rate and term. There are two different types of cash out refinance that we'll go into. One that we refer to as just a standard cash out refinance, and the second is the delayed refinance that you mentioned. These are distinctly different, and understanding them, I think, is important to investors that have equity in their properties that want to access them. Because, as I think you alluded to, Keith, borrowed money is non-taxable. So as another way of leveraging those assets and using them to replace the monthly debt that you would be incurring with more cash flowing properties obviously makes sense to the long-term goals. So the differences between standard and delayed. Let's start with standard. The standard cash out refinance is only applicable in the first 6 loan spots.
Okay.
It requires, in order to use an appraised value, if using an appraised value is necessary for making the loan to value work, you must have 6 months title ownership, at which point you can leverage 75% LTV. So just one more time, in order to go the standard cash out refinance and you need the appraised value, you must show 6 months title ownership seasoning at 75% LTV.
Okay. And we're talking about 75% LTV. We're talking about how we can borrow at a 75% loan to value ratio for a non-owner occupied home. We're just talking about a standard cash out refinance here. So just to give an example, if someone owns a $100,000 income property and they still owe $50,000 on the loan, they can borrow that difference. They can borrow up to $75,000 because $75,000 is 75% of the value. That's the loan to value ratio of the home. So they can borrow up to $75K. They still owe $50K on the loan. So for example, in that case, they could borrow $25K. That's how much cash they could get out for a standard cash out refinance.
Right. Minus closing costs, of course, taxes and insurance. But yes, that's exactly right.
And then the delayed cash out refinance.
Okay, so this is kind of a unique product that most people are not aware of. It's a conventional Fannie Freddie loan, and this is kind of a 180 of what the standard cash-out refinance allows. First of all, it's applicable in any one of the 10 conventional loan spots, and it only allows an individual a 6-month window from acquisition date in order to execute on this cash-out refinance. The time clock starts ticking from the date that will be stamped on the closing statement, the settlement statement, or the HUD-1. That's when 180 days starts, and it is a hard and fast. If you miss that timeline by 1 day, the delayed refi does not apply. The other thing about the delayed refi is that it must be a cash acquisition, sourced in seasoned funds. We already talked about that. So in the right market, what we commonly see on the delayed refi is that if an individual pays cash for a property, and let's say that they got it at maybe a distressed, discounted dollar amount, and perhaps there's some renovation work that is needing to be done on the property. Let's give an example. I think that's a good idea. You've been great about doing that. Let's say that the purchase price of the property is $50,000.
Okay.
And let's say that the renovation work is another $20,000. So all in, they have $70,000 invested into this property. The delayed refi allows us to take the appraised value the day after closing. Obviously, after the renovation work is complete, of course, is when an appraisal would be ordered. But we can go 70% off of the appraised value immediately. The 6-month seasoning, title ownership seasoning that we apply on the standard refi does not apply here. You only get 6 months to execute, and we can go off the appraised value immediately. Now, the appraised value in this example assumes an after repair value or an ARV. So if we have $70,000 into it in our example, and we think that the after repair value is going to be somewhere around $100,000, this is kind of a common scenario, you can see how this particular product can actually produce higher leverage than even an 80 or 85% purchase money transaction. So let's go through that math again. You've got $70,000 in. We think it's going to appraise for $100,000. 70% obviously of $100,000 is $70,000 minus closing costs, taxes and insurance, etc. Let's say the cash back to the individual is $65,000 when all is said and done. So they put $70,000 in and they got $65,000 out. I can't do mental math. Let me see if I can just quickly give you what that actual LTV is.
Okay, and while she's crunching there, this is just, again, we're discussing a delayed cash-out refinance and the difference between that and the standard one.
So if you take the $65,000 back out divided by the $70,000 you put into it, that actually ends up being a 93% leverage, loan to value. So in the right market, for the right property, I've seen this particular product work beautifully in terms of additional leverage that you wouldn't be able to get otherwise. It's been a very popular product over the last few years.
Okay, so in that case, we might not call it a 93% loan-to-value loan so much as we call it a 93% effectively loan-to-cost loan.
Yes, I would say that too.
All right, so that's 7% position, your skin in the game. You know, just off the top of my head, that is about 14-to-1 leverage. But there are some rules, some hard and fast rules. There is a timeline there. A lot of times there are pretty generous rules with these timelines. For example, a 1031 exchange is much the same way, where if you're 1 day late on meeting any of your timelines, the whole thing is rendered such that it will not work and you would not qualify for that. You're listening to Get Rich Education. Our guest is Ridge Lending Group President and CEO Caeli Ridge. More when we come back. I'm your host, Keith Weinhold.
Garrett Sutton here, Robert Kiyosaki's asset protection attorney and the author of Loopholes of Real Estate. As an American or foreign-based investor in U.S. real estate, you know we are a litigious society. You know that you need to protect your real estate and paper asset holdings with the right mix of LLCs and corporations. My firm, Corporate Direct, not only forms these entities, but importantly, we properly maintain them too. If you fail to follow the corporate formalities, you can lose it all in an instant. Corporate Direct is your source for LLC protection and maintenance in all 50 states. Visit corporatedirect.com or call 800-600-1760. Mention Get Rich Education for a free bonus. Switch your resident agent service to us and receive another bonus. It's all good. We look forward to assisting you at corporatedirect.com.
Are you having a hard time finding great investment properties? Unfortunately, the best deals are rarely found locally. Successful investing begins with the right properties in the right markets. Norada Real Estate provides everything you need to invest in the best deals across the U.S. Our simple, proven system will help you create real wealth and passive monthly cash flow. Get your free copy of the ultimate guide to passive real estate investing at noradarealestate.com/guide. That's NORADA realestate.com/guide.
This is Norada Real Estate's Marco Santarelli. Listen to Get Rich Education with Keith Weinhold and don't quit your daydream.
Welcome back to Get Rich Education with our guest, Ridge Lending Group President and CEO Caeli Ridge, ridgelendinggroup.com. So, Caeli, let's talk about the debt-to-income ratio, the DTI. I've found that holds up a lot of would-be borrowers from qualifying for loans. It certainly held me up in the past. So the debt-to-income ratio, that is really the ratio of a prospective borrower's monthly debt payment obligations to their monthly income. So, for example, if a borrower has $2,000 of monthly debt, we're talking consumer debt like car payments, minimum credit card payments, mortgage payments, and so on. If all those are $2,000 per month of debt payments divided by $6,000, $6,000 being the income that borrower has, we'd have $2,000 divided by $6,000, or a debt-to-income ratio of 33%, for example. So let's talk a bit about the DTI. First of all, what are the minimum DTI requirements for these loans?
Well, first, let me just offer, you explained it beautifully, actually. That was very concise. The maximum debt-to-income ratio is 50%. At 50% DTI, we will need compensating factors. These are things like very strong credit scores or strong assets, but 50% will be the threshold. We like to see the debt-to-income ratio closer to the 45% and below range, but it is allowed up to 50% on an investment property. I might also offer that when we're looking at underwriting a loan, there's a lot of moving parts, but the three most heavily weighted criteria for underwriting an investment loan are credit, assets, and debt-to-income ratio. And I feel like you're right, that debt-to-income ratio piece is the most important and often the one that makes or breaks qualifying for a loan. So it is important to understand that baseline.
Okay, so a DTI of up to 50%, 50, allowable for conventional loans, but it sounds like there's some headwinds once you get above 45, and you kind of need to compensate with some other financial strengths if you're going to go above 45%. But 50, that's pretty much the cutoff now.
Correct.
Now, when a borrower already owns investment properties, well, does that income count toward the DTI?
Excellent question. The answer is yes. And depending on when the property was purchased, the formula in which the rental income is calculated changes. I think for this conversation, I'm going to go with the acquisition year formula. This is the easier of the two. And then I think individually, if borrowers want to understand the Schedule E formula for calculating rental income, we can talk about that on an individual basis. It gets a little complicated. But the acquisition year rental income calculation, and this is from the time that you purchase the property up until the property lands on the next filed federal tax return, this is how an underwriter is going to calculate it. We will be able to take 75% of the gross rents minus the property's PITI, principal, interest, tax, and insurance. Now, as an example, let's say that the gross rents are $1,000 a month, and let's also say that the PITI is $500 a month. We are able to take 75% of the $1,000, yielding $750, and then we subtract the $500 PITI, leaving us with a positive $250 a month. That positive $250 then goes into the income column when we recalculate the borrower's debt-to-income ratio. So in that example, it only serves to improve, aka reduce, the overall DTI. I can share with you that in the last 7 years of computing that particular formula, I have not seen anything but the result of a positive number, obviously to varying degrees based on the property and the market, et cetera. But it is a very investor-friendly way of being able to help the overall debt-to-income ratio with that rental income.
That is very well explained. So a cash flowing property should serve as a tailwind, not a headwind to your future investing.
In the acquisition year, yes. Now, I will just briefly summarize. Once the property hits the Schedule E, typically speaking in the first few years of ownership, that positive number we get in acquisition year then becomes a negative number. And if I can just kind of lace back into why it's so important to work with a lender that has that experience in funding non-owner occupied type loans, those are the conversations and education that Ridge provides to its clients to help prepare them. So one of our biggest pieces of advice is for our investor clients is not filing a tax return until a draft version is prepared and we have an opportunity to review it with them, take them through the Schedule E computation, and explain to them in simple terms as we can how that may affect their ability to qualify in the following months. There are some pieces of advice that we would relay, but it's important to know where you stand from that underwriting perspective just to ensure that we're optimizing your qualification piece.
Caeli, that is a great distinction as to why one often needs to go with a lender that specializes in investment property and not owner-occupied home loans. Your owner-occupied home loan mortgage loan officer just isn't going to know to tell you things like that and help you that way. That's what you need to do if you want to add more rental properties in a shorter period of time. Anything else before we leave the DTI, Caeli?
I think that summarizes it pretty well.
What about the credit score requirements? Again, we're talking for conventional financing on non-owner occupied properties here. Tell us about that.
Sure. Kind of like the asset conversation we had earlier, there's two different underwriting buckets that an individual has to adhere to depending on where they are in their acquisition. So for loan spots 1 through 6, the credit score requirements are rather vague, actually. There's no hard and fast rule. And for the purpose of just kind of quantifying this, most individuals come to us with 3 credit scores. These scores come from places that we refer to as repositories. Your listeners will know them more commonly as Equifax, TransUnion, and Experian probably. For the purpose of underwriting a conventional loan, we will take the middle of those 3 scores. So going back to 1 through 6, again, compensating factors play a role here. So if someone that might have a slightly lower credit score, but strong debt-to-income ratio, meaning low, or strong assets, that can be overcome. I've seen individuals with as low as a 650 credit score get approved for an investment loan with those stronger compensating factors. Now, that's loan spots 1 through 6. When we move into loan spots 7 through 10, like the assets, they raise the bar on us again. It does become a hard and fast, and an individual must maintain a minimum middle credit score of 720 or greater to qualify for a conventional investment loan.
Anything else about credit scores that borrowers need to keep in mind? Just even some of those basic things, like don't make any big purchases the month before you buy a new investment property?
Right. There's some optimization tricks that we certainly go into greater depth with our clients if it's on the edge. But maybe just one simple example. When we're talking about revolving debt, typically speaking, you don't want to have more than 4 credit cards. And within those credit cards, the credit limit to the balance owing, you typically want to see that ratio at about 30% or less when you can, and that should optimize credit score. Some might say as low as 10%. In my experience, a 30% limit to balance. So as an example, a $10,000 limit credit card with a $3,000 balance should work to your advantage in optimizing a credit score.
Yeah, we're talking about the utilization ratio there is a significant component of your FICO score. Well, we got pretty nuanced and detailed there, Caeli. So just pulling out and looking bigger picture, I'd just like to know about you. You see so many mortgage loan applications come in there as this place that does a tremendous volume of business, and you see all these scenarios. So you kind of get an idea when you have all these cases, all these questions. Is the overall lending environment, just say over the past 1 to 2 years, is it becoming looser or tighter? What do you see?
I would absolutely say looser. However, I would want to qualify that with, in conventional lending terms, it always kind of feels like 3 steps forward, 2 steps back. But I do see progress. We are finding ways to make it a little bit easier in process. Guidelines are opening up occasionally. As an example, one of the most recent changes that we've seen in the 7 through 10 loan spots, the max leverage on a single family residence was 75%. just recently, like I said, in the last 2 or 3 weeks, it's now 80% loan to value all the way up to 10 finance properties for a single family residence loan. So I think that kind of speaks to the question. The guidelines are loosening a little bit, I think, overall.
Yeah. And this is a really dynamic industry. A lot of times I do episodes I'd like to call more evergreen, but this one here in late 2016, this is a bit more ephemeral than some of the other episodes. So if you're listening to this 5 years from now, you probably want to check back at what the current mortgage loan guidelines are.
Yeah, it's a moving target for sure. We'll see what happens at any point in time. Obviously, it could change, but I think that we're moving in the right direction anyway.
Great point, Caeli. Well, you and your company, Ridge Lending Group, are just a real asset to investors. I mean, companies like you, if you didn't exist, we wouldn't have that conduit between us, the borrower that knows that real estate can really create passive income and a great lifestyle for us, and not having that. So go ahead and give out your website and let our listeners know how they can learn more about you if they had a question that I did not bring up today.
Absolutely. Website is www.ridgelendinggroup.com. You can call us toll free at 855-74-RIDGE is an easy way to remember. And if you want to shoot us an email, that would be at info@ridgelendinggroup.com.
Caeli Ridge, thanks so much for coming back on to Get Rich Education. Well, I hope that you could hear that near the end of Caeli and I's chat. That is exciting. You can now do 20% down on your first 10 single-family income properties. Just a few years ago, you could only do 20% down on your first 4, and then it was 25% down for each additional property. Then more recently, I believe that it changed to 20% down on your first 6 rather than just your first 4. And now it's a 20% minimum down payment on your first 10 properties. That change is just a few weeks old, so awesome news there. So that's 5-to-1 leverage on your first 10 single-family income properties. Caeli was also here on episode 56, where we went over your borrower closing costs, and we broke it down line by line. We detailed each individual closing cost that you pay and why you pay it. And I credit Caeli quite a bit for doing that for us, because I don't want you to have that feeling where you get to the closing table on your turnkey property and you feel like you overpaid because you don't understand something on the settlement statement. No one should have that feeling, and definitely not an informed GRE listener. I am starting to shoot more video. Sometimes out in the real estate investing space, I cannot find video that really helps concisely explain why real estate investing makes more ordinary people wealthy than anything else. So I went into the studio with a producer and 2 cameramen and stood next to a whiteboard and had some footage shot. I really hope that you like that video I sent last week, where I explained in about 4 minutes how real estate makes ordinary people wealthy. That one's probably the most valuable video I've ever shot, where I wanted the viewer to be left like, yes, now I get it. Why in the world would I invest in stocks? That video was sent to the subscribers of our free GRE newsletter. If you aren't subscribed to our newsletter, you missed that video. Sorry. But if you do subscribe now, you will get the next video later. You can grab the free newsletter at getricheducation.com, of course, and you won't just get those videos, but you'll get other valuable stuff. And when you go to getricheducation.com, that includes, something else that our newsletter subscribers already know about, something that they got to the front of the line on, because they already know that I have an announcement to make here that we've opened up new turnkey real estate investing opportunities in the major Texas markets, Dallas, Fort Worth, Houston, and San Antonio, and they're all served by one award-winning provider. And then also, we've opened up turnkey property in Atlanta, Georgia. We're talking about here some of the best stable cash flowing markets that there are. So we've got one company providing inventory in the Texas markets, and they won the 2016 Turnkey Provider of the Year award nationally. So I'm proud and honored to help you there. When you grab the newsletter, you can also find the Texas and Atlanta market page under the resources tab there at getricheducation.com. And, really, I've got to say that the resources have never been more valuable there at our website. So leading up to next week's milestone episode 100, grab our newsletter and resources at getricheducation.com. And thanks to Caeli Ridge, check out ridgelendinggroup.com. We'll see you next week. You weren't here for me, you were here for you, so don't quit your daydream.
You've been listening to Get Rich Education, telling you what the wealthy won't tell you about real estate and investing.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
Cash flow real estate investors nationwide and worldwide, this is Get Rich Education's Keith Weinhold. Forbes has rated Memphis, Tennessee as the #1 cash flowing market in the world. Our good friends at Mid-South Homebuyers have been Memphis's premier turnkey real estate provider for 14 years with a stellar reputation and an A+ rating with the Better Business Bureau. Owner Terry Kerr was born and raised in Memphis. Yeah, he knows the market and has renovated and sold over 1,000 houses in the Memphis area. Find out what their many repeat buyers already know. Their houses are completely renovated, even come with a 1-year builder's warranty and a lifelong rental guarantee. They're a perfect fit for the first-time out-of-state investor or the seasoned investor diversifying their portfolio. Mid-South Homebuyers' friendly staff makes investing easy. Learn more at midsouthhomebuyers.com or give them a call at 901-217-HOME. The preceding program was brought to you by your home for wealth building, GetRichEducation.com.